Good afternoon, everyone. Tyrone here. This is the Wealth Hustle. I'm going to go ahead and say it right from the start. Hit subscribe. Share this with a friend. You are really going to want to sit back and listen to this, and you're going to want your friends and family to be made aware of this video, because what we have, no exaggeration here, is life changing. We got a request from one of our YouTube subscribers, one of the channel subscribers, Linwood. Linwood wanted us to do a video on dividend reinvestment plans. And I really wanted to do this previously, but I said, now that I've got the question from Linwood, I want to put together a very concise video that talks about this powerful concept. Dividend reinvestment is so powerful because it basically works on the principle of compounding, okay? Compounding, which I'm going to explain to you in just a moment, is a force that, combined with time, creates massive amounts of wealth, okay? So, here we go. A dividend reinvestment plan. Now, we've talked on this channel before and on the platform about dividends. Some stocks pay dividends. Dividends is basically income, okay? So you own the shares, which gives you an ownership stake in the company, and then on top of that, you get income. So you're making money in two ways: the appreciation of the value of the underlying stock, and then also the income. Now, what you do with those dividends, what you do with that income is powerful, okay? It can be. You have some choices you can make. You can take the dividends and put them in your pocket. For example, stocks pay, let's say we got a stock, ABC stock, okay? And they pay, let's say, on an annual basis, they pay $1 per share in dividends. So the way it usually works is, for every share that you have, on a quarterly basis, ABC will pay you 25 cents for every share you have. So after 4 quarters, that 25 cents per share will equal, of course, $1. So if you got 200 shares in the company, then they'll pay you a total of $200 on an annual basis, okay? $1 per share. Now, you can take the $200 and put it in your pocket. At the end of the day, you can tell them that, just send you your dividends. Or you can reinvest your dividends. Reinvesting your dividends is a smart idea. Now, let me just get a little housekeeping note out of the way first. Even if you reinvest your dividends, you're still going to have to pay tax because it's still income. And when you reinvest your dividends, you're buying more shares in that company. So, you reinvested those dividends. You did make a purchase. You used that income to do something, which is how the IRS justifies taxing you on income, even if you don't put it directly in your pocket, even if you reinvest it, okay? So, let's go back to our imaginary company, ABC. ABC, let's say they have their shares. Let's make this very simple. Let's say each share in the company, at the end of that year, okay, you got the company trading at around $200 a share, okay, at exactly $200 a share. Let's say it just didn't move for whatever reason, just for the sake of illustration. The company shares are $200 a share. $100 per share, each share of ABC stock. And let's say you got $200 in dividend payments. Well, if you're reinvesting those dividends, then you're purchasing 2 shares of stock. You got $200. Each share cost $100. You got 2 more shares of stock. Okay? So now, where you started out with 200 shares, now you've got 202 shares. Okay? So you see how that starts to work. Now, another way that you can think about this, I think it's an easier way to go into just a definition of the difference between simple interest and compound interest. All right? So follow me. Simple interest, let's say you got $1,000. Let's say you got $10,000. Okay? You got $10,000 and you put it in an account that's going to pay you 5% simple interest. Simple interest means you get the interest applied to the principal amount. In this case, $10,000. All right, so at the end of year one, you will be paid 5% of $10,000 is $500. So at the end of year one, you have $10,500. Going through year two, you're going to get that interest again applied to the principal, which is still going to be $10,000. So you get another $500. So at the end of 2 years, you've got $11,000. Okay, your original $10,000 plus the $500 you got for the 5% interest on year one and year two. Okay. All right, now let's look at compound interest and let's see how that works. Taking again $10,000. This is your original investment. You throw in $10,000. The first year, you're going to get 5% on that 10 grand. That 5% is going to equal $500. 5% of 10,000 is still 500. But in the second year, this is where the magic starts to happen. In the second year, you're going to get interest applied not to $10,000, but to $10,500. Okay? So the second year, you're going to have not $11,000, but $11,025. So you can see where in the second year, the simple interest has already been beaten by compound interest. All right? Now, I hope that that is a very simple way to explain that to you. And so you can see the power now behind when you go in and start to reinvest your dividends, how that starts to, again, compound. Okay? So you started out with 200 shares of the company. In our example, you moved up and you got 202 shares of the company, okay, because you were able to reinvest those dividends. So you didn't come out of pocket and buy anymore. You just used the income from your dividends to do it, okay? You used that income to do it. So I need to give you some examples, some real world examples of how this works. And I pulled up a few and I want to go through a couple with you. All right, PepsiCo. PepsiCo, we all know them. We all love PepsiCo. They are the company that makes Pepsi. They've got Frito-Lay and some other things as well. So if you'd invested in PepsiCo in 1980, okay, let's say you bought some shares of PepsiCo in 1980. Let's say you had $2,000 in PepsiCo. If you'd reinvested the dividends, that $2,000 investment would now be worth $150,000. And this range actually is from 1980 to 2004. Okay. So in about 24 years, you would have accumulated $150,000 off of that original $200,000 investment, so $148,000 return. And this is just based off of reinvesting your dividends, not buying any more stocks, okay? Instead of when you did the $2,000 initially, you would have built up over the course of time 2,800 shares by 2004, from 1980 to 2004, with just reinvesting your dividends, okay? Powerful. Very powerful stuff. I'm sure you can understand the wealth building ability inherent in something like compounded interest and dividend reinvestment. So how do you dividend reinvest? How do you do it? Actually, it's easier than ever. Now, a lot of companies have a way that you can reinvest your dividends with very low fees, okay? So, for example, I went on to Disney's website. I do not own Disney, although I'm evaluating it, to be quite honest with you, because Disney is doing some really big things. They've got the Star Wars franchise, they've got the Marvel franchise, and then they bought the assets from Sony, so now they've got Spider-Man, they've got the entire Marvel universe, okay, is under Disney now, in addition to Star Wars. So what does that mean? It's not just movies. It's merchandise, okay? It's toys. It's blankets for the kids' bed. It's theme park rides. It's all of this stuff that they can sell. So Disney has a program where you can buy shares directly from the company. And you go in, and they have a really, really good website. If you go to shareholder.broadridge.com/Disney investor, and I'm going to put that in, don't worry about it, I'll put it in the comment section, in the description section. But Disney has a phenomenal site here that gives you the option to start an account. There is a minimum that they charge. Well, you must purchase a minimum of stock. They give you your transaction history. You can trade the stocks, buy them and sell them right there. You can download your tax forms, and you can manage dividends, okay? So when they say manage dividends, I suppose what they mean is if you want to, because you can allocate a certain percentage of your dividends being reinvested. You don't have to reinvest them all. I like to reinvest them all because I'm going to spend the money on buying more assets, income producing assets. Remember what we said. The rich, they purchase assets, income producing, appreciating, value appreciating assets. So put the money back in the asset. Don't take the money and, not know what the hell you did with it at the end of, a 60-day period. You know that it's in the shares of stock that you purchased. So I'm going to include this site in Disney, the Disney site, in the description section. And another cool thing about Disney in particular, I just want to mention it to you. They actually have a collectible certificate you can buy. This is pretty cool because what you can do, I'm a really big fan of this. Purchase a stock certificate. Okay, some people need a tangible reminder that they own something, all right? And too often, that tangible reminder is something that is not appreciating in value, but depreciating in value, like a car, okay? This stock certificate that you can buy from Disney is a really nice certificate. And when I show you, when you link to the webpage, you'll be able to see it, okay? And you can hang it up in your kid's room and give them a constant reminder that they own a part of this multi-billion-dollar enterprise called Disney, okay? You can purchase shares, actual physical shares of a variety of companies, and I encourage you to do that. Just one, and frame it, and hang it up on the wall as a constant reminder that you do own something extremely valuable. You own a company. So this is the message today. I hope it has been very helpful. Again, subscribe to the channel. Tell your friends about it. Tell your family. Tell some of your enemies. They won't even be your enemies after you tell them about the Wealth Hustle and get them turned on to what we're doing here. Follow us on Twitter and also like us on Facebook. All right, so Linwood, I hope that answers the question that you had. Again, we're using the power of compound interest, or interest on interest. Just a quick definition. Compound interest is the interest an investor earns on his original investment plus all the interest earned on the interest that has accumulated over time, i.e. interest on interest. Hustle on. Talk to you soon.